Hi, I'm Melissa Bill, and welcome to the Business Roundup, where we catch up with the movers and shakers in the business world. Today, joining me is Dr. Robert Murphy. He's a renowned economist who is applying his economic principles to the modern day fintech. Thank you for joining me today.
Thanks for having me, Melissa. Glad to be here.
Now, I know fintech, just finance in general is a big topic. You have Fed cuts, you got just different things happening in the industry. Can you give us a little bit about your background and just how you got started?
Well, sure. So just so I understand, me specifically or the company?
Well,
Because
you
it's
specifically and then the
okay, sure.
company.
Right. So I have a PhD economist. I thought I was going to just be a college professor and write books and journal articles for a career. I did teach for a few years at Hillsdale College in Michigan, and then I was doing research down at Texas Tech for a while. But on the side, I had always been interested in life insurance, and so I had done some consulting in that respect, that I helped design a training program for financial professionals who were using permanent life insurance as like cash management vehicles. So there's always sort of like two tracks going on in my career. And one of the graduates of that program went on to found the company Infineo, where I'm currently the chief economist. And what Infineo was doing is taking life insurance and putting it on the blockchain. And so it was sort of, that's kind of our elevator pitch is what we're doing. We're taking this centuries old, very stable, conservative financial product and then also marrying it to this sexy new technology that, people first learned about via Bitcoin. And the reason they approached me is just in terms of my academic background. Again, I had set up this training program that was just telling people how to use life insurance in this specific fashion, but also I had done some stuff on the economics of Bitcoin, pretty early on, when that first came out, just to kind of foster the conversation and let like the tech guys be able to talk to the finance guys in terms of how does Bitcoin even work. And so that I was kind of the person that they thought this is the one to go to. I was intrigued by the concept, and then I've been here for 3 years now at Infineo, and that's what we're doing, is putting life insurance on the blockchain.
And now, how is Infineo helping modernize this insurance industry with tokenization?
Okay, sure. So I'm sure many of your listeners and viewers already know this, but just to be clear, so what we're doing is not crypto per se, right? What we're doing, it's a subset of what you referred to there as real world asset tokenization is kind of the term they've used. And the idea is, once people understood how the blockchain worked in terms of this decentralized consensus, this public ledger, as it were, that keeps track of, who owns what Bitcoins, and you have the private keys to be able to move them around. And like once people understood that technology, they realized, oh, we can use this for more traditional assets as well. And so what tokenization means is that you have some real world asset, stocks or bonds or real estate or whatever, or life insurance policies. And then in a sense, you create like a digital twin. So some token that moves around on blockchains that sort of points to that thing. And so there's a lot of efficiencies for this. The model we used was Figure Market. So they were doing it with HELOCs on the Provenance blockchain. And so like one of the sort of informal models we had is that we want to become, sort of like the figure of life insurance. But what it does, amongst other things that we can get into as this conversation goes on, Melissa, is it gets rid of a lot of the unnecessary middle steps in the process. And so that's just one obvious example. But as far as like some of the more esoteric things that this is going to allow, so it's not here right now, but where we're building towards is that if you can represent individual life insurance policies by tokens on the blockchain, then you can also like strip them down into their various components and rearrange them, and you can build what we call life-backed securities. All right, which is just, combinations. So it's analogous to a mortgage-backed security, but here it's built up from life insurance policies. And then there's a lot of interesting properties that I, as an economist, I've written white papers and things on this, because life insurance is very stable and dependable. And so there's interesting, derivative products that you can build with combinations of these things. But what's great about the blockchain is the transparency. So the problem back in 2008, among other things, was that various firms were holding these mortgage-backed securities, and really they didn't know what was in them, right? Because it was so complicated. They had a bunch of physics PhDs who gave it a clean bill of health, and they were wrong. Whereas with things on the blockchain, investors can go through and just keep clicking through layers and see exactly what goes into these things. And so that's just one example of the transparency. Another thing too is just, the convenience of being able to trade things 24/7. You don't have to wait for the markets to open and close. And then finally, for life insurance in particular, one of the advantages of using certain types of policies, or permanent life insurance, is cash management vehicles, is they have this inbuilt liquidity feature where contractually the carrier has to give you policy loans upon request. So that's one of the reasons people like these policies for that purpose. But even there, there can be a delay. The interest rate, it could be fluctuating. And so by putting these things on the blockchain, it's ultimately just going to open up the market. Lenders around the world who understand the nature of this collateral can, lend to people on better terms than they might be able to get just via a carrier.
It's interesting. So kind of how real estate was that kind of stable asset. It's going to be kind of, are you hoping that this will step in and become maybe even better?
Yeah. And so, with all this stuff, let a thousand flowers bloom sort of thing here. But right, there are, depending on what the asset holder is looking for in a particular item, we think for certain types of people in certain use cases that specifically whole life insurance is the thing that my research really focuses on, as a particular type of permanent life insurance, just beats every other asset. So specifically, I have a white paper that we did for Infineo looking at what's called the Sharpe ratio. I'm sure many of your listeners know that. It's basically like a risk-adjusted return. So it's like the numerator is how much does your asset outperform some benchmark, and then the denominator divides by the standard deviation of the returns, right? So that's like the more it outperforms, the better the score. But if it's more volatile, then it dings it, right? So that's kind of the thing. And so I compared a curated sample of whole life policies against the Case-Shiller, so real estate prices for the U.S., S&P 500, gold, Bitcoin, AAA corporate bonds, 10-year treasuries, and the whole life insurance outperformed on the Sharpe ratio against all those other asset classes. So what that means is, for somebody who wants just, very dependable, sure and steady growth over the long term, we think this is like the preeminent asset. And so that's, so we're tokenizing that, and then, building tokens like stable coins and things like that, if you want to get into later in the conversation. We think with whole life insurance policies as being the backing for that we think is a much more stable foundation than just about any other asset.
That's very interesting. And now, why life insurance? Why is that an excellent asset for tokenization? You were kind of going into that.
Right. Yeah. So again, just empirically, looking backwards, I did over long stretches and just showed that it did have much more stable returns. So part of it is just the culture. Like, if you just think about what function does life insurance serve, people are not buying life insurance policies for the investment returns, right? Like, you buy life insurance to check the box and say, okay, if something happens to me, we can pay the house off and my wife and kids are taken care. That kind of thing is like a standard breadwinner mentality. And so just the investment managers of these companies, they have very long-term liabilities, right? They're taking premium payments up front, and they got to make sure that they can make the death benefit payment possibly 5 decades in the future, right? So they're very long-term oriented. And so they just engage in careful, maturity matching and buying long-term assets and so forth to meet their liabilities. And again, it's not, especially, and we have a preference at Infineo for what's called mutual companies, where there's hybrids of mutual holding companies where the policyholder is also the owner of the company, as opposed to like a stock-based company. And so the culture of these places, and I speak from experience, like I've written books on this, and I've interviewed the people on these investment committees, where they're not trying to impress their investors with quarterly reports, right? It's really about the long-term strength of the company. So there's that element, and so that's one element. But also, in terms of just this particular asset, just one little quirk here that is interesting, I think, and your listeners being savvy financial people will understand this. There's a sense in which you might say, okay, but how could it be safer than like treasuries? Like, isn't that the preeminent safe vehicle? But there's an important distinction if you're talking about like long-term maintenance of your dollar value. Let's say you have 2 piles of assets, and one is a pile of life insurance and one's a pile of 10-year treasuries. Well, if interest rates spike, there can be a huge unrealized capital loss on the treasuries, right? Let's look at what happened to Silicon Valley Bank. When they got in trouble, it wasn't because they were dabbling in crazy exotic derivatives. They were sitting on long-term treasuries, and then, the Fed raised interest rates, and that's why they got into such big trouble. Whereas with life insurance, there's no interest rate risk. And the reason is inbuilt to a permanent life insurance policy is what's called the cash surrender value. So as you're making your premium payments, as long as you don't, miss your contractual obligated payment, the part of the policy, yep, there's a face death benefit, but then there's also what's called the cash surrender value. It marches up over time. And so at any given moment, you can just turn the thing back into the carrier and get a spot payment. And so if it doesn't, if interest rates go up, that it doesn't change the schedule of your guaranteed buyback price. And so that's what I mean when I say that there's no interest rate risk on these things. So yep, there is a very small default risk on the carrier. It's possible that a carrier mismanages its finances, whereas presumably the Treasury is in a stronger position. So there's still that element. But in terms of interest rate risk, these things are actually safer even than long-term Treasuries. So for all these reasons, that's what I'm saying. This is a very conservative asset historically. Like I say, it has outperformed on a risk-adjusted basis every other asset we looked at, and it's got a lot of nice properties built into it. And sort of this sleepy little thing like life insurance. People don't think of that as like this great backbone of a financial plan, but yet I think in many respects it could be. And that's partly, just to go to your earlier question, I think maybe we'll get into, is the benefits of tokenization. That there's, you might say, if it's so good right now, well, then how come everyone's not using this thing? And what is the benefit of tokenization? So am I getting ahead of ourselves here, or do you want me to
No, I
speak
mean,
to
we
that?
could definitely talk about that. And also, I wanted to discuss too the convergence of the trade fi and the blockchain based finance. So a little bit of both. Can you kind of go into that a little bit?
Sure. Yeah, right. Yeah, so again, as I'm sitting here touting all the virtues, and I alluded to in the beginning, before I got involved with the blockchain based finance element, I had set up this training program with some other people, just showing financial professionals, hey, you can use these, specially designed life insurance policies as cash management vehicles for small to medium sized business owners, for example, that, they can get some large policies, and there's lots of tax advantages and things like that. And again, one of the elements is that you've got this cash value that grows over time. And it's not, it's not going to knock your socks off, but when you take into account the tax issues and so forth, the after-tax return is pretty decent on these things. So again, to have something that's just kind of sitting is this backbone that just marches up over time that you can quote bank on, like that's, part of the security of these things. So given that, though, you might say, all right, well then, how come large institutional money managers aren't just piling into this as an asset class if it's got a higher Sharpe ratio and all this stuff? Because, they're in real estate, they're in bonds and whatever. And part of the problem is there are a lot of frictions with the conventional industry in the life insurance sector. So one huge example is, to take out a new policy, you need to demonstrate an insurable interest, right? That, for obvious reasons, the underwriters of the carriers aren't going to let someone just take out, basically a bet that, if this guy over here dies, we get $1 million. No, you want to have an insurable interest to make sure the incentives are aligned and things like that. And so that is a huge hindrance to someone who just for purely financial reasons might want to have exposure to this as an asset class that you can't just take out. You can't just say, hey, give me $5 million of exposure to life insurance next Tuesday. It doesn't work like that. There is like a market, what's called life settlements, for outside investors to, pay people to sell their policies to them because it's a, transferable asset, but that's heavily regulated. And in that sector too, traditionally, like you might have seen ads on TV about like, hey, sell your life insurance. They're going after older people because those particular investors just want, the death benefit. So like they want the lifespan to be whatever, less than 8 years, let's say. Whereas the kind of thing that we're talking about here is just using these policies for their internal cash growth. And, it's fine if the person's 30 years old and is expected to live for decades, that's exactly the kind of policy that would serve as a good foundation for like a growing, portfolio of just in terms of marching up in terms of its cash. So because of these reasons, I'm saying that's why what we're doing here at Infineo is building this platform where we can take conventional life insurance, put it into a pool, tokenize, fractional claims to that underlying cash of the entire pool. And then that's what trades on the blockchain rails, is that underlying, so a portfolio manager, if he looks at our white paper and says, oh yeah, I do see that the Sharpe ratio here is good, and maybe I will dial back my exposure to treasuries and load up a little bit on that he could just get into our tokens that are claims of that. It's not that he actually has to get ownership of life insurance policies on a bunch of people he doesn't know, right? So anyway, I'm just trying to show that's kind of how that works together. As far as your question about just like the convergence of blockchain and TradFi, yeah. So what we're doing here, as I say, we're putting life insurance on the blockchain, but I participate in a lot of like X spaces and other venues where we just have roundtables of other pioneers who are taking different types of assets and tokenizing them as well. So just for example, like there's people that are taking like very rare collector item vehicles, like, you know, a car that was in a Fast and Furious movie or something, you know, some really interesting collector item that might have a market value of whatever, $400,000. So it would be hard for some individual just to write a check and buy that, but they tokenize it and then sell like 1/64th claims to that, and so that brings it to a larger crowd. So I'm just saying, there's people tokenizing, you know, vintage bottles of wine. There's so lots of things where people might have this like curiosity or hobby interest in something that by tokenizing the underlying real world asset and putting on the blockchain, it's just opening up liquidity and bringing it to a lot of people that traditionally it would have been out of their reach.
Yeah, I heard about that, especially with like art, like the art scene that was really big a couple of years ago. And now,
Yeah. So in general, yeah, it just opens up liquidity, and also two things like, you know, somebody, it wouldn't be just a matter of, let's say, you know, the hypothetical person that, oh yeah, I want that car that was in the Fast and Furious 2 or whatever, and here it's $400,000. Here you go, and then you have it, and then all of a sudden, what if you hit a cash crunch? It would be hard to just go to a regular bank and say, here, I want to put this car up. Can you lend me $50,000 against it? Right. Whereas again, if what you actually bought were tokens that everyone understood legally, and that's part of the issue, is to make sure everyone realizes and that the law endorses the fact that, yes, if I have electronic control of this thing on a blockchain, that legally is the same thing as if I own 1/64th of this car, right? So that's, you know, some things that the regulation and so forth that's happening is helping to solidify that. But it's much easier to pledge this token that could be transferred to anyone on planet Earth as long as they have an internet connection, and you know, pledge that as collateral, and you lock it up with a smart contract and whatever, and borrow against that, and then people can just send you stable coins, right? So that's what I'm saying, is this is spilling over in the blockchain arena. More and more like household name investment banks and whatever, they're sinking more into this. So this is no longer just, oh yeah, Bitcoin's like this weird thing that a bunch of tech guys do over on the corner, and then over here we've got traditional finance. Like the worlds really are merging. I think, you know, 10 years from now, the idea of having blockchain based financial transactions is going to be as commonplace as just people using email now. Whereas when email first came out, that was still kind of a weird thing.
absolutely. And I've seen even changes. I do think that the regulatory part is, as it forms, is that going to make it easier and make things kind of more streamlined?
Oh, definitely. So, you know, I have my disagreements with various things the Trump administration is doing, but where I'm wholeheartedly, you know, applauding their efforts is, you know, Trump is coming through on his promise to like make the U.S. the AI and crypto capital of the world, right? That through the various things, you know, we can talk about the Genius Act in a minute if you'd like, but yeah, they're definitely, you know, they're like, the U.S. is open for business. We want people to build here, and it's as simple as that is. That is a night and day difference, and this isn't just my opinion. Like I say, I rub shoulders with lots of people building in this space. And for a while, it was just thought that, okay, we're going to develop our new technology and our business model outside the U.S. because the regulatory climate in the U.S. is either indifferent or outright hostile, like the way it was, you know, under the Biden administration, presumably would have been if, you know, under a Harris administration, if she had won, where it was both explicit and sort of implicit, where people just realized that, yeah, they don't want us doing this stuff here for various, you know, reasons, that maybe they thought it was too hard to regulate or whatever. But now certainly the message is, and there's lots of concrete, tangible evidence to show that, yeah, we want you building new blockchain based products and services here in the United States.
Yeah. And like, can we discuss that a little bit? What are some of the key points behind the Genius Act?
Well, sure. So the Genius Act specifically refers to what are called stable coins. And I'm sure most of your viewers know this, but just to not leave anybody behind, a stable coin is a digital token that trades on blockchain rails, but its function is to maintain parity with some other asset. So the most popular ones maintain parity with the US dollar, right? So like one stable coin, with its, Tether, or Coinbase has theirs, USDC, that they're supposed to have a market value of exactly $1. Now, in practice, they might not, it might deviate, but there's supposed to be mechanisms in place that if it falls to 98 cents, that will push it back towards $1 and so forth. So where that, just to give a little of the background, because at first when you hear that idea, you might think like, well, what? I thought the whole point of like Bitcoin or whatever, especially if you go to the early days and read, that genre of the people who were excited about Bitcoin, it's because they didn't like government issued fiat currency. And they're like, oh yeah, the dollar and the euro and the yen, these things are, you can't stop them. They can just print more money and whatever. And that's why we have rampant inflation. Whereas Bitcoin, nobody's in control of that. That's this autonomous thing. So let's get into that. And if we could just get more people into this non-inflationary. And so given that, the historical background of the origin of the excitement over this new thing called Bitcoin, it's funny that right now, like, one of the leading things that's traded on blockchain is something that by its design is tied to the value of the US dollar. But the reason for that, like where that came from, is that originally, people who had their wallets and they had portfolios of all these different cryptocurrencies and Bitcoin and Ethereum and some of the more exotic ones, they were very volatile. And so, maybe, I made 82% year to date on my Bitcoin. I want to, take some profits. I want to park some of it in cash. And so before stable coins, you would have to like sell that off to get US dollars wired to your checking account and like sort of take it out of the blockchain world and put it back in the TradFi. Whereas if you have other tokens that live on blockchains that are designed to maintain parity with the US dollar, you can, just trade some of your Bitcoins or Ethereum or whatever for some stable coins, and then you sort of park your money, quote, in cash, right? So that's where these things came from. And so the problem is that these things in the beginning were largely unregulated, and people weren't sure, like, well, what's backing them up? Like, yes, thus far we can look at the history and see that these things tend to trade close to par with the dollar. But what if there was a financial crisis and everyone's rushing to redeem them? What would happen? And so what people realized is these stablecoin issuers were like banks, in the sense that people would wire them, real dollars in the sense of like checking account balances, then be issued these stable coins that at least, ostensibly were supposed to trade at par, and they'd be going and doing things with them, buying stuff from merchants or whoever who accepted stable coins as payment. So that, like I said, the stablecoin issuer was like a bank where, if you think of a conventional bank, you go in with green pieces of paper, you make your deposit in your checking account, and you're walking around town saying, oh, Citibank owes me $1,000. And then merchants will accept, liabilities from Citibank as if it's the same thing as if you had a $100 bill. But technically they're not the same thing, right? So it's likewise here. You might think I have $1 million worth of Tether or USDC, but what if there's a panic in the markets and then the exchange rate drops? Maybe you don't, right? So the Genius Act was supposed to sort of clean all that up and provide assurance to Americans, because that's the jurisdiction, that if you get what's called a payment stable coin from an approved issuer, that you can be sure they have assets backing it up. And so specifically, it requires 100% reserve backing of, circulating stable coins. And when they say, well, what kind of assets can count as reserves, it's pretty stringent. So it's like literal checking account balances or, currency coins, but also treasuries, but they have to be 93 days of maturity or less left on them, right? So the idea is to have very liquid USD denominated assets that are like backing up 100% all of the stable coins. And again, the function of that is to sort of foster trust in this system, so that as more and more people, are using stable coins in their commercial transactions in terms of like living on the blockchain side of things, that they know that, oh yeah, if I have what I think is $200,000 worth of stable coins, it really is $200,000, because ultimately the issuer has those in very liquid, safe assets that I could present them to be redeemed, push came to shove. So that's the main thing of what the Genius Act does. One other element that's important is it prohibits stablecoin issuers from paying interest to the holders of their coins. And so I think that's partly just to kind of solidify that loop that we just talked about, that like right now, a regular checking account, how are they able to pay you interest? As everybody knows, it's because when you give them $1,000 in currency, they don't just put it in a vault with your name on it. they go and lend it out to other people, and they earn a spread, and then they give you some of it back. Right? Lately, the interest isn't very significant, but historically, you could get whatever 3% on your checking account. How are they paying you money if they're just holding it because they're lending it out? But then that maturity mismatch is why bank runs can happen, right? That everybody, oh, I gave your money to Mary, and so forth, right? So what they're trying to prevent that with the Genius Act, and to say, no, we don't want the stablecoin issuers to be taking in a bunch of actual cash, issuing stablecoins that people think are redeemable upon demand, and then they go and invest it in something that's a 5-year turnaround time. So partly to nip all that in the bud, is they prohibited the payment of interest to the stablecoin issuers, like to make everyone realize, no, this thing is like, it's just like a claim ticket on very liquid dollars that the stablecoin issuer is keeping somewhere. This is just a more convenient way to trade your claim on that money that's parked there.
Make it safer. Now, if someone wanted more information on your company or you, where would be the best way for them to, what would they go to the website?
Yeah, so I would just point people to the website. So infineo, infineo.ai is our main website. And there we've got lots of blog posts. I have a podcast and so forth, and all of our white papers.
Okay, awesome. Now, your podcast, what is it called for people who want to check it out? Is that on YouTube?
It's called, it is. Yeah. I would go to infineo.ai to get the, the archives, but yes, it is on YouTube and Spotify and everywhere that quality podcasts are hosted. But yeah, we call it Infi. So it's sort of like a play on DeFi because, we're Infineo. And so that's the idea. And it's, I might just be commenting on the economic news of the day because I'm a professional economist by training, but also, yeah, I interview people in terms of other blockchain based projects and talking about news, in the life insurance space, things like that.
Awesome. Well, I want to check it out as well. And I really appreciate you joining us. Thank you for joining the Business Roundup, where we always try to bring you interviews with some of the leading people in business, whether it be technology, finance, or energy. I hope you tune in. I hope you subscribe and listen, and we'll give you updates for new interviews that are coming up. Until next time, I'm Melissa Bill.